Hello and welcome to Fund to Money. Here we'll be talking about arbitrage funds, which are getting popular once again. Now, the idea is to give you an idea about how it can be used smartly. Whether you want to secure your gains, your made gains through equity investments. This could have been made over a long period of time or a short period of time. You want to secure them. Your financial goal like a retirement or children's higher education is around the corner. You made gains and you want to secure them. You need a safe parking slot again. You've got a large lump sum, say severance pay or retirement benefit or large inheritance or something like that, and you want to figure out where to invest, and you need a parking slot during the time you're making the plan. You again need a stable sort of a place, broadly stable place where the money will grow. So in all these three or four requirements for emergencies, you need a stable parking slot where the money would be easily accessible, it will be tax efficient, it will grow for a little while. For all these requirements, arbitrage funds they fit the bill. And as we are witnessing volatility in equity markets, arbitrage funds are coming back into the focus of people. So we are going to be first talking about what arbitrage funds are, some of the essential features, and then of course we're going to talk about its use in a great detail. So before we take a short break, it's worth talking about what arbitrage funds are, which is basically they are equity oriented hybrid funds. So that means they have a mix of equity and debt broadly, like many other hybrid funds, but it's equity oriented. So 65% or more are in equities. But what basically arbitrage funds does is get arbitrage benefits in equities. So basically, some shares are being bought in the sort of spot market, shall we say, or the cash market, and their investments are being made in the derivatives of the futures market, and arbitrage opportunities, because the pricing is pricing differential has been spotted, mispricing as it's called has been spotted. Those benefits are taken advantage of. So this is primarily the equity side of it, because it's the same stocks or same shares who are being bought both in the cash and derivatives market. So the length of investment, which is often a cause of risk, higher risk in many most asset classes rather, that gets eliminated. That's why it brings a certain shall we say predictability or stability, certain level of stability in the returns, because the risk is lesser. So you wouldn't find too much of upward and downward movement, which is basically what happens when the markets are volatile. And ironically, arbitrage funds actually do well when the markets are volatile. So this is one element which makes it a good parking slot. The other part, of course, are the debt investments, where the investments are being made into zero coupon bonds and deposits and debentures, and that is the other element which makes it a lower risk sort of investment. So you would find that arbitrage funds typically have a benchmark which is comparable to the benchmarks of liquid funds, which is another lower risk mutual fund, basically lower risk debt funds, which we recommend for emergency funds. We are giving you the links of our discussion. Now, arbitrage funds also, we recommend that you team it up with liquid funds. Arbitrage funds we have recommended for a period of 1 to 3 years, when you want to put money in that part of emergency funds, which you would be keeping for 1 to 3 years. And if it's a little more longer, then rather we we would say that the part where you would need the money for a shorter period, that you would keep in arbitrage funds, and for a longer period, typically 3 years or more, liquid funds. What are the reasons? We'll be discussing them in detail, but this is what a good parking slot, a secure, relatively low risk parking slot is all about. That's what arbitrage funds are there for. So in the next section, we'll be discussing some of the major features of arbitrage funds and how they can be used. So we'll be back shortly. Don't go away. Welcome back. Welcome to Fund to Money. We are discussing arbitrage funds. Should you be buying them? How they can be used? And what are their main features? So let's get started and talk about their major features. So we have already talked about how the arbitrage funds actually operate. Now the most important part of arbitrage funds, according to us, is its taxation. Now because of that, a lot of its uses come into play, and as we said, it's an equity oriented hybrid fund where 65% or more is invested in domestic securities. That's what makes it into an equity oriented investment, or equity oriented fund, or equity oriented hybrid fund. That's how one can put it. So which means for capital gains that you make under 1 year, they're classified as short-term capital gains. You pay a short-term capital gains tax of 15% for them, and of course for capital gains made over 1 year, you pay and which are when the annual gains are more than 1 lakh. These would be termed as any gain that you make over 1 year would be classified as long-term capital gains, and you pay long-term capital gains tax of 10% on annual capital gains, which is annual long-term capital gains exceeding 1 lakh. You pay 10% on that, right? So this is the treatment. So therefore, what happens is, if you now start comparing it with liquid funds, they are arbitrage funds obviously are at an advantage. We have already done a discussion. We're giving you links because under 3 years, any capital gains that you make in liquid funds, which is again a low risk debt fund, they are they're classified as short-term capital gains, and they're taxed at the income tax rate. So at 30% tax slab, which is the highest tax slab, clearly arbitrage funds will score. Arbitrage funds also will do better than savings accounts. So if there's a large amount of money that's lying idle in savings account, you'll find the returns to be much higher in arbitrage funds. So you can put that money out there and it'll work. Typically arbitrage funds do very well when markets are volatile, but the other issue is when they get very popular, more money comes in, more people are trying to get arbitrage, tap into arbitrage opportunities, those opportunities start shrinking. So then with large inflows coming in, arbitrage funds may not do as well. When the money again starts moving out a little bit, it becomes less popular, then arbitrage opportunities again go up. So these are cycles they operate. That is why we suggest that, because of the tax efficiency, for the shorter end of your short-term requirements, we recommend arbitrage funds, and for a slightly longer period of time, which is 3 years plus, we recommend liquid funds. Now as we know, for 3 years or more, as for all debt funds, you get inflation indexation benefits, which basically reduces the taxable capital gains, and on that you pay 20% long-term capital gains tax. So it works pretty nicely for those in the 30% tax slab. So now what arbitrage funds are, as we said, are very good parking slots. One is for emergency funds. These are the part where you're replacing your income. where suppose you are changing your profession, you're going to do a course for continuing education course, all these things, or you're going to change, start a business. This is where you have to replace your income. That's where a cocktail or a mix of arbitrage funds and liquid funds actually help you. For immediate requirements, you might want to keep money in your savings account. So you need to have a mix of these investments. And of course, as we said, that if you get a large lump sum, and you are waiting for it to invest for, say, regular income or growth, then this is a right place to park the money. So suppose you want to convert it into a regular retirement income, you can then invest it into a debt fund through a systematic transfer plan, or a portion of your retirement flows that you've got, lump sum flow. If you're getting a severance pay or some large lump sum, some bonus or something like that, and you want to invest again through systematic transfer plan, you invest in equity funds. So depend, when you want to change the course a little bit, you do that. You made a gain, in the recent past you would have made a gain in equity investments, and you want to secure it, again arbitrage funds. You can then choose other equity funds, or what you could do is you can wait for a little while and then invest. Also, when the goals are coming near, say your child's higher education is around the corner, then you take off the gains and you sort of shift the money regularly to a systematic transfer plan and bring it into arbitrage funds, and then you can convert it. Either you can use it, part of that money you can use it as lump sum and then again deploy it, maybe in debt funds or something like that, or a liquid fund or something like that. Depends on what the requirement is, and you can do that. So see how well arbitrage funds actually work. A lot of people keep talking about arbitrage funds as if it's one investment and it's going to it's a good antidote for volatility, which it is. But the important part which gets missed out is how well it marries with your it can be used with your financial sort of goals. So now, important thing is that for us, as we said, for a longer end, you need to basically for income emergencies, expense emergencies, or the health emergencies, whether you need the money all of a sudden. For income emergencies, that's where a combination of arbitrage funds and liquid funds work. One would argue that debt funds give you a higher return, or rather dynamic bond funds give you a higher return. But remember, in emergency funds, when you're looking at emergency funds, it's not the returns that you're looking at accessibility. And because it's a large amount of money, because you're trying to replace income, you would then would want some growth. But the first thing is security, and with some level of growth. So keeping that in mind, that's why we are talking about a combination. Otherwise, obviously, for longer periods, say about 4 years or so, dynamic bond funds will obviously do better, but they have a higher risk. Right now, what are the things that you need to keep in mind when you are looking at arbitrage funds? Now, you need to make sure that you are transferred it in a bulk, in one lump sum. You do it because arbitrage, depending on how the position is, there are periods when there's a lot of volatility. That's when arbitrage funds do well. Other times when there's not much volatility, then they are unlikely to do as well. So keep that in mind. Do check if you're being sold an arbitrage fund. Do check the riskometer. It should be comparable to what a liquid fund is, somewhere around that. So riskometer tells you how much risk is being taken. See how the fund has been operating over different periods, say 6 months, 1 year, 3 year, 5 year, and it should be doing well. So the important thing is arbitrage fund should be doing well both in bull markets and bear markets. So that consistency you need to establish also, because these funds try to take advantage of arbitrage opportunities. Therefore, it is very important for you to see how it is adding on to the expenses. More transactions you do, investment transactions you do, more costs you incur. So you need to look at the expense ratio also apart from your returns, right? But for this, you can take the help of an advisor or an expert and get an understanding. Higher the expense, it eats into your returns. So although returns for certain requirements, returns is not what you're looking at. You're looking at as more as a parking slot, which also gives you some level of growth. So therefore, this is what you should be looking at. Now, a lot of people also talk about you getting a baseline growth over a period of 5 years or so, but over a period of 5 years, if you want a baseline growth, you probably are better off with an equity oriented hybrid funds rather than an arbitrage funds, because you will find they would typically be performing better. So arbitrage funds, in our opinion, is out and out parking slot, which also helps you grow the money. Remember, the arbitrage funds have a 30 to 60 day lock-in period, so you need to keep that in mind when you are investing. And as we have said, that volatility is a key prerequisite for them to do well. So we hope you found this useful. If you have found it useful, hit the like button, share it with others, and subscribe to our channel. Till the next time, take very good care of yourself, and goodbye.